54%. That's how many global fund managers, the professionals who move billions daily, now say AI stocks are in bubble territory. But here's the thing, they're still buying. Welcome to Money Moves Daily. I'm here to cut through the noise on one of the most heated debates in markets right now. Is AI the next .com crash or something entirely different? Before we continue, remember, this is not financial advice. Always consult a qualified advisor before making investment decisions. Now let's look at what the data actually tells us. $440 billion. That's how much Microsoft, Alphabet, Amazon, and Meta plan to spend on AI infrastructure in the coming year alone. Let that number sink in. But here's the uncomfortable question. What if 95% of the companies betting on this technology see zero return? Because according to MIT research, that's exactly what's happening right now. Today we're examining the collision between unprecedented spending and uncertain returns. The question isn't whether AI is real. It clearly is. The question is whether current prices make any sense. We'll walk through the numbers Wall Street doesn't want to discuss, what the .com era teaches us, and a framework for positioning your portfolio without betting everything on one outcome. Let's start with some historical perspective. Every transformative technology, railroads, electricity, automobiles, the internet, has featured a boom and bust cycle. AI won't be different. The railroad bubble of the 1840s saw massive overbuilding. Shares collapsed. But the railroads themselves, they reshaped civilization. The technology was real. The valuations weren't. The .com crash offers the clearest parallel. The internet changed everything. But 90% of .com stocks went to zero. Even Amazon fell 94% peak to trough. The survivors. Amazon, Google, delivered extraordinary returns. But picking them in advance was nearly impossible. For every Amazon, there were 100 webvends heading toward bankruptcy. Here's what matters. The .com crash wasn't caused by the internet being fake. It was caused by prices that assumed everything would go right. Sound familiar? Today's AI market shows eerily similar patterns. Massive corporate spending, uncertain returns, and valuations that price in perfection. But there are important differences we need to examine. The biggest difference, the companies leading AI today, Microsoft, Google, Nvidia, actually have massive cash flows. .com companies burned cash. These companies print it. Nvidia posted record earnings. Microsoft's cloud revenue is growing. These aren't promises on a pitch deck. They're real dollars flowing through income statements every quarter. And this is critical. Having cash flow doesn't mean you can't overpay. Cisco had real revenue in 2000. Its stock still fell 86% and took 16 years to recover. The question isn't whether AI companies make money. It's whether they make enough money to justify today's prices. And that's where the numbers get uncomfortable. Let's look at the concentration risk first. According to Yale School of Management, in late 2025, 30% of the S&P 500 was held by just 5 companies. That's the greatest concentration in half a century. 5 stocks, mostly AI adjacent, now drive nearly a third of America's most important index. That's not diversification. That's concentration risk. The Bank of England has taken notice. They've issued formal warnings about growing risks of a global market correction due to possible overvaluation of leading AI tech firms. When central banks start warning about specific sector valuations, historically that's been a signal worth noting. They don't issue these warnings casually. Now let's examine the spending side. Capital expenditures from Microsoft, Alphabet, Amazon, and Meta are expected to rise 34% to roughly $440 billion combined. BlackRock Investment Institute projects another $5 to $8 trillion in AI-related capital expenditure through 2030. That's trillion with a T. The build-out is just beginning. But here's the uncomfortable data point. According to MIT Media Lab research from August 2025, despite $30 to $40 billion in enterprise generative AI investment, 95% of organizations are getting zero return. Zero return. Not low return. Zero. For 95% of organizations, that's not a technology problem. That's an implementation problem. And implementation problems can persist for years. The Motley Fool recently asked the obvious question. Nvidia's CEO says there's no AI bubble. But what do the numbers actually say? They found the answer isn't straightforward. Nvidia's revenue growth is real. They've delivered consecutive quarters of record earnings. But their stock price has grown even faster than their earnings, stretching valuations. The survey data is stark. 54% of global fund managers now view AI-related stocks as being in bubble territory. That's more than half of the professional money. Yet, here's the paradox. Many of those same fund managers continue buying. Why? Because underperforming a bubble can cost you your job faster than writing it down. Yahoo Finance captured this tension perfectly with their headline. I took investors on a date in 2025. In 2026, analysts say it's time to foot the bill. The bill is coming due. After 2 years of promises and projections, investors are demanding proof. They want to see revenue, not roadmaps, earnings, not expectations. January 27, 2025 marked a watershed moment. Chinese startup DeepSeek launched a chatbot that triggered a 17% single-day drop in Nvidia shares. DeepSeek raised a critical question. What if you don't need Nvidia's most expensive chips to build competitive AI? What if the moat is narrower than investors assumed? The software sector felt the aftershock hardest. CNBC reported that the AI-driven software rout accelerated through January and February 2026 as investors reassessed the winners. Here's the irony. AI's success might actually harm some software companies. If AI can write code, what happens to companies selling to developers? Creative destruction works both ways. OpenAI's valuation trajectory captures the mania. In October 2024, they were valued at $157 billion. By late 2025, that had tripled to $500 billion. $500 billion for a company that loses money on every conversation. The bet is that eventually, AI will be so valuable that profitability becomes inevitable. That's a big assumption. BlackRock put it directly. For investors, the question for 2026 is whether the eventual profits will justify the cost of the current build-out. That's the trillion-dollar question. Literally. Let's separate the AI market into two categories that behave very differently: infrastructure plays and application plays. This distinction matters enormously for your portfolio. Infrastructure plays are the picks and shovels. Semiconductors, cloud providers, data centers, power generation. Someone has to build the roads before the cars can drive on them. Nvidia sits at the top of this category. Their chips power the AI training runs. Whether AI delivers on its promises or not, the training runs are happening now. Nvidia gets paid today. Application plays are the companies trying to use AI to build products and services. These face a harder path. They need the technology to work, customers to pay, and competitors to stay behind. Historically, infrastructure winners emerge before application winners become clear. Cisco won the early internet. Amazon and Google emerged later. The sequence matters for timing. The bears make a compelling case. That 95% zero return statistic isn't just one data point. It reflects the fundamental difficulty of implementing transformative technology. The bulls counter with earnings. Nvidia's latest quarter showed real revenue growth. Not projections, not promises, but actual dollars from actual customers buying actual products. Both sides can be right simultaneously. AI is real and revolutionary. And AI stocks can still be overvalued. These aren't contradictory statements. They're both true at once. The middle ground acknowledges complexity. Maybe semiconductor companies have more visibility than software companies. Maybe the hardware winners will emerge before the software winners. There's a reason Nvidia has held up better than many AI software plays. Their customers have to buy chips to even experiment with AI. Experimentation requires infrastructure first. The concentration risk compounds everything. When 30% of the S&P 500 rides on 5 companies' continued AI success, any stumble reverberates through every index fund and retirement account. This isn't abstract. Your target date retirement fund probably holds significant positions in these 5 stocks. Your 401k is making an AI bet whether you chose it or not. The dot-com parallel suggests caution, but also patience. The technology was real. The survivors delivered generational returns. But timing and selection mattered enormously. If you bought Amazon at the peak in 1999 and held through the 94% crash, you still made extraordinary returns. But could you hold through 94% down? That's not a rhetorical question. Most investors can't hold through that kind of volatility. Understanding your actual risk tolerance, not your theoretical risk tolerance, matters more than being right. So what should you actually do with all this information? Let me offer a framework, not recommendations, but a way to think through the decision for your own situation. First principle: avoid concentration risk. Even if you're extremely bullish on AI, no single theme should dominate your portfolio. Diversification remains the only free lunch in investing. Second, distinguish between infrastructure and applications. Chips and cloud tend to have more near-term visibility than software companies, whose business models AI might actually disrupt. Third, look for actual revenue, not just AI narratives. Press releases are free. Earnings require customers. Companies with real AI revenue today have proved something. Companies with AI announcements haven't. Fourth, consider dollar-cost averaging into AI positions rather than making large lump-sum bets. In a volatile sector with uncertain timing, spreading purchases reduces the risk of unfortunate entry points. Fifth, and this is important, remember that even transformative technologies can produce investment losses if purchased at the wrong price. The internet changed the world. Most internet stocks still failed. The historical pattern suggests that skepticism and patience often beat euphoria and urgency. The best entry points usually come after the first wave of enthusiasm crashes into reality. That doesn't mean waiting for a crash. It means sizing positions appropriately for an uncertain outcome. It means being willing to underperform a mania, rather than overexposed to a collapse. Ask yourself, if AI stocks fell 50% tomorrow and stayed down for 3 years, would your financial plan survive? If not, you're probably overexposed regardless of your conviction. Conversely, if AI delivers on its promises and you own none of the winners, would that change your life materially? Missing a bubble isn't a tragedy if your plan still works. The professionals are hedging. That 54% bubble warning didn't stop them from buying, but it changed how much they bought. Position sizing is how professionals manage uncertainty. BlackRock's advice for 2026: build portfolios for a range of outcomes, not just the most likely one. They're the world's largest asset manager. They're not making all-in bets either. The smart money isn't asking bubble or no bubble. They're asking, given uncertainty, how much should I allocate? That's a more useful question with a more actionable answer. Let me address the emotional component directly. Fear of missing out is real. Watching friends profit while you sit on the sidelines is genuinely difficult. Bubbles exploit this psychology. But regret works both ways. Holding through a collapse is also psychologically devastating. There's no emotionally painless path, only the discipline of following your plan regardless of feelings. The best investors make decisions before the pressure hits. Decide your AI allocation now, when you can think clearly. Write it down. Then follow the plan when emotions scream otherwise. History shows that predicting exact bubble timing is nearly impossible. The dot-com bubble lasted years longer than skeptics expected. AI could do the same, or it could correct tomorrow. What history does reliably show: diversified portfolios with disciplined rebalancing tend to survive and thrive across multiple cycles. No single bet, however compelling, should jeopardize that outcome. The AI build-out will likely continue regardless of stock prices. Those $5 to $8 trillion BlackRock projects aren't discretionary. Companies feel they must invest or risk obsolescence. That creates a floor under infrastructure spending even if application returns disappoint. Someone has to supply the chips, the servers, the power. That's not hype, it's accounting. The power demands alone are staggering. AI data centers require electricity at scales that strain existing grids. Utility companies and infrastructure plays benefit regardless of which AI apps succeed. Consider broadening your definition of AI investment beyond the obvious names. Energy infrastructure, real estate, cooling technology. The picks and shovels extend further than most realize. If you're determined to increase AI exposure, consider what percentage of your portfolio already holds it passively. Index fund investors often have more AI exposure than they realize. Review your total portfolio. 401k IRA, taxable accounts combined. Calculate your actual AI concentration. Many investors are surprised to find they're already significantly exposed. With 30% of the S&P 500 in 5 AI-adjacent stocks, a simple index fund already makes a substantial bet. Adding more AI on top might create more concentration than you intend. The irony of today's market: broad diversification actually requires avoiding the most popular stocks. True balance might mean consciously underweighting the names everyone else is buying. None of this is to say AI will fail. It almost certainly won't. The technology is real, the applications are genuine, and the transformation is already underway. That's not the question. The question is whether current prices already reflect that future success, or even exceed it. When expectations are priced for perfection, reality usually disappoints, at least initially. Perfection is a high bar. Companies must hit every earnings target, every product launch, every competitive moat defense. One stumble, as Nvidia showed with DeepSeek, can erase months of gains overnight. The professional money is preparing for volatility. They're not necessarily bearish. Many remain long. But they're hedged, they're diversified, and they're not betting retirements on single outcomes. So where does this leave us? AI is real. AI stocks may be overvalued. Both statements can coexist. The intelligent response is positioned for multiple outcomes, not committed to one. The framework that survives bubbles: own quality assets, stay diversified, rebalance systematically, and, most importantly, never let any single position threaten your entire financial future. Remember, this content is educational only, not financial advice. Consult a qualified advisor before making investment decisions. Past performance never guarantees future results, especially in transformative sectors. The AI story will keep unfolding. The fundamentals will reveal themselves. Your job isn't to predict. It's to position wisely and adjust as reality provides data. That's the signal in the noise. Thanks for spending time with Money Moves Daily. If this episode helped you think through the AI question, share it with someone facing the same decision. Until next time, stay sharp, stay diversified.